it's not so easy for AI to replace a treasurer. Of course, there are certain elements where AI will be helpful, but AI will not be in a position to judge if this cash forecast is good or bad, given the current political situation or the current business understanding, because
Oliver Gerstberger works in Group Treasury and Asset-Based Finance at Geo Corporate Funding Advisory and serves as a corporate treasury advisor at Leasing Pilot. He advises companies on funding strategy, liquidity management, and the implementation of asset-based finance solutions to strengthen their financial structure.
Can you tell us what is asset-based finance and how do treasurers miss out on it?
there are various ways of financing assets. So for example, factoring, you finance your receivables, is one form of asset-based finance. If you, like Wolf Crane or others, have machinery, equipment, or in our case, tower cranes, you could lease them. Why do I believe that many treasurers miss out on the leasing element? Banks.
Hello and welcome to this latest episode of Treasury Leaders, our new podcast. Used to be called Corporate Treasury 101 and now it's rebranded in Treasury Leaders. I'm really excited in having Oliver Gerstberger as our guest for today. Oliver is Group Treasurer of Wolf Cranes and has a lot of experience in many other companies, including Selecta, the vending machines where you get your coffee in the morning, probably. What sets Oliver apart is his very hands-on approach. He is the kind of treasurer who will go to the production floor, talk to people, and really try to understand what makes the company tick and what is behind the numbers. He's also an expert in asset-based finance. You don't see that a lot. And if you are a treasurer listening to this and you're not doing too much with asset-based finance, this episode might be for you. It turns out that you might be missing out on a nice, opportunity, arbitrage opportunity or not, we'll see, but it can be very useful for you. And lastly, Oliver started his career in banking, which is not too uncommon, but he made a very conscious decision to switch to corporate treasury, and even taking a salary cut to do so. He's very driven, very clear on what he wants to do and what he wants to achieve and why. So these are a few of the pillars I'd like to cover today talking with you, Oliver. 1, your hands-on approach on treasury. 2, what are the opportunities in asset-based finance? And then 3, why treasury when you started somewhere else? Oliver, it's really nice to have you.
Thank you, Philip, for being here on the call with you.
Let's start with hands-on treasury. Looking at your career, what was the moment where you realize if I just stay behind my desk, I won't create enough value as a treasurer?
For a few years, treasury at Selecta Group, the one with the vending machines and the coffee machines. And yeah, I built what was in the treasury book. So I built, when there was nothing, a treasury system was implemented, the cash pooling, everything else. But still, cash flow was not as good as management hoped for. Of course, treasuries cannot single-handedly change it. But then when I really started speaking with the MDs, with the FDs, and also with the operational leaders, I recognized, look, I actually miss out on something. And what did I miss on Selecta? Well, there was a large capex every year. So we bought new machines to be put into the market. But actually, what changed the economics was refurbishing vending machines. And that's also a different approach for treasury. Instead of funding new equipment to go there, let's look, okay, what can we do with our existing asset base, with our existing machine park to actually make the asset sweat more? And then when I went to the factory, the refurbishment center, I saw 2 vending machines. One was brand new, unpacked from Evoca, and the other one looked exactly the same. But it was a 20-year-old box just with a new front door. Then I said, okay, my job as a treasurer is to educate our financing parties that we should not only finance the new stuff, but also combine it with old stuff because it gives better value. The customer pays the same for the coffee. The client who has something in his hospital pays the same monthly rent for the machine if it's new or not, if it looks appropriately well maintained. And that was the moment I said, look, it's not just good enough to have the best treasury system and be scored at top notch in the treasury survey by all the consultants because you have done all the steps they recommend. No, you must be there and understand the business, the shop floor, what drives business, the unit economics. And I believe understanding unit economics will really help you as a treasurer to understand how you can improve the cash flow of a company.
So it's not only maximizing your return on, say, excess cash on what money market fund, on how to make that money give a better return, but it's also how can the money make a better return on your actual business. So don't buy a new machine, refurbish it, and that will give you a higher return per euro.
Exactly. But then when you go one step further, frequently I notice that Treasury comes into play when someone has already decided on that should be bought. But Treasury should be early in the CapEx decision process. So why should we buy what and how should we finance it? When it's ordered, let's say it might be too late. It might be a few weeks, maybe a few months before it's being delivered. So when you are involved in certain decisions, okay, we have the facilities or actually the money on the bank account to finance this, then later you don't fall into this trap of, okay, I need to finance 3 projects, but only have money for 1.5. And then everybody says, why don't you have money for 3? The business decided on 3, yeah, but the banks don't really like 3 projects. They don't give us the money. So we must do something. And then it becomes, I call it unpleasant for everybody, for the business who has promised something to the client or the customer, for the treasurer because he couldn't deliver, because the market doesn't appreciate the way the company wanted to do it, and management, let's say, then being disappointed that the business case can't be materialized and. So summing up, I believe you must be involved early with the business in certain decisions and not just sit, you could call it the ivory tower, in your finance team in the corner and just report to the CFO. You must be really integrated with the business, and I believe at least twice a month you should have a touch point with relevant parties.
And if you look at your peers and many other corporate treasuries, businesses out there, what do you think are they missing today? Can you give example? What are 3 things that a treasurer should do today to become more hands-on, to do more how you do it?
Important for today's treasurers, I believe, is really understand the unique economics of the business, what drives it, theoretically by the P&L, not just like look at the cash flow, look at the P&L and understand the P&L. But the P&L is built of very different elements. And one is basically, if you're a manufacturing company or a renting company like Wolfcrane, what actually is the cash flow profile of our assets over the lifetime of the assets. And I see many treasurer professionals, let's say, not going that deep into, let's say, those discussions and actually asking to be involved. It's not just like the strategic planning. It's okay, what is our 3 to 6 months planning process for the CapEx? What are the approval metrics? Where should I be involved as a treasurer? Don't wait to be asked to fund it. Ask to be included early on at certain moments. Not every step, of course, but when it becomes relevant. And I see many people, let's say, optimizing the financial structure, as you mentioned, getting the best money market return on something. But I believe that the best money market is, for companies I work, not to have so much debt on the balance sheet, or actually invest the money you have into growth. And that is the way I see it.
Okay, thanks. And then what? So you have spoken to the people on the floor, you are involved in the business and making decisions, you are aware of your assets and your business. What other things could you do?
I have seen that working capital is the next source of financing the business. And I personally believe working capital should be overseen or managed by Treasury, because we see very different elements. We see the payables because we approve the payments. We see the customer inflows on the bank account. We finance the capex and we know about the money being invested into inventory. The other different departments might not be aware of, let's say, what does it mean to the cash flow? So when there's a year-end push and someone says, I give you a 1% discount, dear customer, if you pay in December, that's nice for the December result. But you as a treasurer, if you don't know that this happens, or if you don't warn some other people, you might just fall in the January trap, because everybody paid you in December. You have a great January in terms of cash outflow. And then on the payables, someone says, yeah, I extended for another 60 days. That's good for the moment, but actually you as a treasurer should know that early enough to change your cash flow forecasting either model, or if it was done manually, to make sure that you actually capture this And then it comes on the inventory side. If you just do a last purchase order because one of your suppliers stops and you suddenly have the whole inventory filled up by 5 million euros equivalent for something, you must know, because you suddenly must buy these products and it doesn't fall into the normal payment pattern. So I really believe you should own or at least oversee the working capital development and manage it with the other leaders of the function. And that again requires regular interaction with the sales leaders, with the MDs, or with the procurement leaders. What do they do? How do they do? Can we work together and improve the cash flow, but also the P&L of the company? And I really believe just looking at cash flow is falling short, but just looking at P&L is equally falling short. So everybody says EBITDA is a number, cash is a fact. But if you just look at cash and not at the P&L, you might miss out that the company is not making that much money as they believe. And therefore, you must do something as well as a treasurer.
Maybe let's focus on working capital a second. I think you gave a good summary, but let's try to break it down for also the least experienced treasurers or people not familiar with treasury. What is working capital and what are you trying to do as a treasurer? And then we can maybe break it down for the listeners there.
So working capital is a combination of what you invoice to your clients or customers, so the account receivables, what you pay to your suppliers, services, goods, that the accounts payable, and what you actually have in stock in the factory or in the yard or in the warehouse to deliver to your customer base. That is true. In my case, I always work for companies having some stock. Of course, if you're a software company, then there's no stock. You just have the payables and the receivables, and the stock might be minimally.
And most companies I talk to, or most treasurers, they obsess with paying as late as they can and as receiving as early as they can. Do you see the same and you share this view, this almost obsession?
Half. So, of course, I love to be as paid as early as I can. But I noticed also as the selector, at some moment DSO went longer and longer. So we had, let's say, a structural issue in the way we invoiced. So if the treasurer just waits for the money to come and it doesn't come, and then you ask, why is it coming up? The customer complains about ABC, or I don't know, there's an issue in operations. At some moment, you must look closer and start a working capital project. So I love to be paid as early as I can. To pay as late as I can, everybody loves the quarter end optimization. I believe doing it for 1 or 2 weeks is not nice to your supplier base, but everybody understands it. If you go beyond that, I personally believe that that's the wrong approach. I have seen many times that procurement is very proud presenting to senior management, we have extended from 30 to 60 to 90 days. Everybody gives a big applause. And then you as a treasurer say, now it's Q2, we have to pay 8 million extra compared to last year because we didn't pay in Q1. Why didn't we pay in Q1? We extended the payment terms. What everything was due in Q1 is now due in Q2. And then I saw many times people starting running, screaming, that can't be, Q2 must be good, it can't be bad. And therefore I developed my own philosophy saying, look, procurement is a very complicated process. You talk about quality, stranded costs, everything. But in the end, I always prefer a bit of shorter payment terms, somehow in line with your production cycle, but not longer. Because if it falls into another reporting period or maybe 2 reporting periods later, nobody will recognize that this was a sin or the result of 2 quarters before.
Because the organization forgets.
Exactly. The organization just forgets the good or the bad and carries on. And depending if you have, let's say, a stable cash flow profile, a stable revenue over the quarters, you have a one-time hit. But if it has seasonality, then it becomes quite crunchy. And I really say, look, I rather have the good result in terms of P&L and cash flow, the inflow and the outflow in a similar time frame. So within 3 months, everybody understands, I sold it in January, I have to pay in March. Or I sold it in February and I have to pay in April. That is still connected. But if it goes out for more than 2-3 months, I believe that's not the right approach. And I would rather try, and that comes back to my P&L comment earlier, I would rather advise a business and my function as group treasurer to go for a lower unit price, having P&L lasting in the year-end numbers, than longer payment terms.
So that means when you're negotiating, negotiate a bit shorter terms. So you pay your suppliers, say, 30 days instead of 90, and you get a bit of a discount from that. Is that what you mean?
Exactly. And I believe it's not uncommon, or what I've seen, to get a 2% discount for that. And if you say, look, for 60 days, shorter payment terms, you get 2% discount, multiply it with the right number to come to the analyzed result. It's better. And then the next value creation, what the treasurer would do, it would make a business case out of it. What if we paid our suppliers structurally earlier and take out an extra bank loan? Can that make money?
Well, 2% for 60 days, you say?
Yeah.
That's compounds to quite a lot on a yearly basis.
Indeed.
So if your loan is less than 10%, you have an arbitrage opportunity here or not?
Exactly. And the procurement people might not come up with the idea because they're always focused on paying later. But you can say, look, let's actually hunt the discounts. Let's structurally ask for someone, let's take out a bank loan for 10 million and fill it up with the ones who have best discount for us. And then you do the mathematics, and I would say 9 out of 10 times you will make money, lasting money in the P&L. Of course, your financing documentation must allow this extra loan. Your covenants must allow this extra loan. But if it does, that's a real opportunity for Treasury to create a lasting impact.
And that's not even accounting for the non-monetary benefits. I can imagine as a supplier, if you pay me in 30 days rather than 90 or late and extend, I might be much keener to give you better support, better services and so on, because you'll become one of my best clients, isn't it?
Of course, yeah. I mean, that's the same. Everybody loves being paid early. As I said, I also love being paid early. So suppliers love to be paid early. It's then quite important that you actually stick to the promise. And the quarter end optimization, if it happens, it's not more than 1 or 2 weeks. People will understand it, but not appreciate it.
And Oliver, leveraging on your hands-on approach and going into the business, looking into how things actually work and making the most of it. You gave a few examples already. I also know you as an asset-based finance expert. Can you tell us something about that? What is asset-based finance, first of all, and how do you think it can be used, and how do treasurers miss out on it somewhat?
There are various ways of financing assets. So, for example, factoring, you finance your receivables, is one form of asset-based finance. If you, like Wolf Crane or others, have machinery equipment, or in our case, tower cranes, you could lease them. Why do I believe that many treasurers miss out on the leasing element? Banks, and many treasurers like me, come from the banking side. They pretty much understand all the capital market products, the bank loans, but they're not really used to, let's say, financing assets. For that, they have leasing companies in the market. Actually, many banks are not even department-wise in a position to judge the quality of an asset. Whereas the leasing companies, when they finance, for example, a tower crane, they know exactly how long the tower crane lasts, what type of configuration, what's the market price. So they can really say, okay, even if the quality of a company, the credit rating, I make up a number, is a B minus, the asset itself can lift this B minus to a higher rating, and you can get a cheaper financing compared to just a corporate loan. The little challenge is that you must find the companies who are interested in financing those assets. And sometimes those companies need a little bit different information than the banks. And you must tailor the information package to those recipients. And then you have a great extra source of funding. And the 3 ways of, let's say, for me, finding out if someone really understands asset-based finance, everybody, if you wake him up at 3 o'clock in the night, will tell you the margin on the syndicated loan or the margin on the bond or whatever. If you ask him what is the amount of lease financing, not financial lease according to IFRS, but really lease financing for equipment you have, some might know. Frequently the answer is, I must ask accounting. Then if someone knows and you ask them, okay, what is the average rate you pay in absolute or relative terms, I would say 90 plus will not know. In case they know, then you ask them, okay, do you know actually when those contracts expire and what to do at the end, or just a year, half a year before the contract expires, 3 months before? I would say you have lost 99% of the crowd. But there's such a great opportunity. So for example, in the Wolf crane case, all our tower cranes are financed by leasing companies, not by bank loans. We have in our financing documentation carved out that basket and say, look, financing of cranes runs separately. It has to be treated differently. Also at Selector, we had a huge leasing basket available, but nobody was using it. So I started structurally using this leasing basket to finance all our annual capex. And then suddenly you speak about the small and the big names, but you must find them. And the challenge then is, okay, how much actually can you fly when the credit appetite is filled up, when you need to have the second one? But in the end, I always, in Selector's case, got at least 200, 300 basis points cheaper than the high yield bonds, which we took out. I mean, Selector had very highly priced loans, and we could easily get 300, 400 basis points in Swiss franc cheaper, in euros 200, 300. So it was an arbitrage opportunity. And if you try to max out the leasing basket to the max, you have another source of value. But it comes back to my earlier point. You really must understand how the business needs the capex to come to be financed, because you must organize those facilities early enough so that then they are ready when the capex needs to be paid. You cannot come 3 weeks, 4 weeks before the capex needs to be paid, then you're just too late. And if you sit in your ivory tower, as I would call it, I guarantee you will be too late. And then Treasury comes in this crunch position. Someone says, yeah, we must pay it 3 times 5 million. Okay, that gives you a 15 million cash flow problem for the quarter, as you as the treasurer guy, and you're responsible for the end cash position. So rather start early with this. And asset-based finance, for me, in all the Selector years, but also later, was the right opportunity to finance even specialized assets. And now when colleagues listening to this podcast say, yeah, but I don't have assets, I can tell you can even finance software, and software implementation is a leasing contract. It's not just the hardcore asset, the crane, which you can see here in the background of this picture, or the cars or the copy machine. No, I would say nearly anything can be financed by leasing if it's not a real estate.
So you gave a nice example in there where you said that at Selector you had a leasing basket available. So it had been carved out in the agreement with the bank. So that's step one, right? First, carve it out, otherwise you cannot do anything.
Exactly.
And then you had it was available, but no one was using it. So your point is, have a look what is available, what can be done. And then you're saying the terms can be much better than the bank terms. So you're saying 2-3%, 200-300 basis points difference. So that is huge. And lastly, you said still to make it happen, you need to prepare documentation, make it easy for the leasing company to digest it, to understand it.
That's exactly right. So a leasing company focus on the asset. I don't want to say they are simple-minded people. That's certainly not true. I saw very, very sophisticated lessors, but they have a different approach. And a bank, you give them the investor relation package, the annual results, the annual report, the financing documentations. They love to read these 300, 400, 5 pages documents. Leasing companies, I would say, hate it. So it's important to really prepare a little package for them. I call it small info memo. Can be 3-4 pages if it's simple, can be 15 pages if it's longer and more complicated, like a whole production line with some self-created assets, intangibles, and what have you. But if you make it pre-cooked, so that they really can copy-paste it into their credit approval process, then they really love it. You say, look, I mean, this is our financing structure. These are our covenants that are the baskets which are allowed. We are here, that's written on that page of the financial report for the quarter, or here is another extra analysis why this asset creates value, why this project is good for us. You help the leasing companies to understand it. The banks disregard it because they're really interested in the big tickets, or they're particularly interested in certain assets like real estate. But production equipment mostly is, let's say, out of scope because banks don't have the capabilities in terms of departments and or the skills in terms of people to really understand it. For that, you need another kettle of fish. And I believe asset-based finance companies leasing companies if you talk about receivables factoring companies, are really right there, and treasurers should not miss out on that opportunity.
And it's interesting that you say that, well, normally creating an easy to read info deck is not on the top 10 skills of any treasurer, but you're saying that actually becomes important and useful to do to secure good leasing terms or good terms in general.
Indeed. And now, thanks to AI, if you, like me, are not really entertained by writing little memos, I mean, you can do 75% of the work with AI. You just give the document and say, give me a good summary, and then you have at least the structure. And you can, with your knowledge of a treasurer, knowing what is relevant, you can actually improve that. And over time, if you build your own agent, you can really make it work. And you have less work as a group treasurer to do that, or as a senior treasury analyst. I mean, that's something where I really see a use case for AI in treasury to help you. And then it creates value. You unlock another source of funding, which mostly you have not done because working asset by asset is too complicated. So you rather work on the bank loan.
And actually, looking at the bank loan, in your experience, is it easy to negotiate with the bank to have the basket for leasing available? Or do you ever encounter resistance? Or do you have any tips for treasurers listening on how to do that?
Negotiate it in at the beginning. If someone, let's say, legally owns the asset, let's say in the financing documentation, say, look, actually would like to finance it, then it becomes complicated. Because even if the relationship supports the case, he has to go back to the credit committee. The credit analyst always wants to protect the downside. So says, no, I don't give anything because it's already in my position. So I deteriorate my position for what? So then maybe as a treasurer, you need to pay a little bit of extra margin. If it's too late or nearly too late. If it's from the beginning not part of the financing documentation, then you're quite good. And actually there is maybe this other opportunity with leasing, not just like for new asset, but also for existing assets, sale and lease back. If you have your financing documentation and you maybe negotiated it, let's say a few years ago, you just negotiated before the current political tensions, and now you go back to the banks, unfortunately, the interest margins might have increased. So if you now want to have this extra of 10, 15, 20 million, they say, yeah, you can have it. But unfortunately, it's not just the incremental which will be priced higher, it's the entire financing which is priced higher. And asset-based financing, they say, look, I have the company as the one paying, I have the asset, which is another collateral, and I just have one piece, so I don't need to look at the whole structure. And there can be real opportunities compared to your existing financing, which frequently I see colleagues not using to the possibly best extent.
Thanks. Well, you make a very good case for that. You mentioned AI in your talks, and I want to touch upon AI with you a little bit as well. But first, let me switch a bit on the human side and about yourself. So you also mentioned you started as a banker and then you changed. Why did you do that? Why not stay as a banker? Seems like quite a comfortable career, isn't it?
It is. I had two thoughts or three about it. So one, I was a number of years in banking on the corporate desk advising companies about FX and commodity hedging, but you just see one part of the transaction. You do the FX, you do the commodity hedging, but you don't see the whole chain. And I studied business administration because I liked to be with the business. And I felt, yeah, I fall short. At the age of 30 or 30, I fall short about what I wanted to do 6, 7, 8 years ago. So that was, let's say, the desire to be more involved. The second element was I saw banking at the time in 2012, 13 being under more and more regulation. So actually you were more documenting than spending time on creating value for your client. And thirdly, that was a very personal matter. There was a change of senior management, and the new senior management in place on purpose forgot the plans which were made for my career. And after 2 times discussing and hearing, we don't have any plans for you. So, okay, that is a very honest answer. Thank you. But then I pursue my own plan. So I then started to work actively of switching into corporate treasury. So I call it the driver's license for corporate treasury, the corporate treasury certificate from the Swiss Association. Even if I knew a fair deal of what was taught, it's like with the police. If you don't have the driving license, nobody allows you to drive. If you don't have this certificate, the ACT certificate, they might not fully believe you that you're equipped to work or run a treasury function. And then I found the opportunity to enter into the corporate treasury. But yeah, being a few years in banking, you had this nice cushion of a good salary. And when you start at the entry level corporate treasury, that's unfortunately not the same salary level. So I voluntarily decided to do a salary cut to move into corporate treasury. A few years later, that was fully compensated. But I thought at the age of 30, I will not most likely enjoy the next 35 plus years in banking. So I must change something. And I said, okay, I go to what I really enjoy. And I haven't regretted being in corporate treasury.
So in the bank, you were relying on plans made by others for your career, whereas as a corporate treasurer, you feel you can make your own plans. Is that right? You're in more control?
You can better make the plans. Of course, depends on the type of organization where you are. But corporate treasurers are closer to what happens in the company, to the action. Whereas at the bank, even if it's a smaller bank, there will be quite a number of people. There's a customer relationship manager, and he only sees a certain part of it. I thought, look, I mean, if you really want to make an impact and do something, and if you're not an entrepreneur, I believe for me, corporate treasury was right, because I'm working close with the finance function, the CFO. In many cases, I worked also straight with the business owners or managing directors, because some really understand that cash is important in driving the growth. And if you are in such an environment as a corporate treasurer, also very focused of creating an impact, making the cash grow or improve the cash generation capacity of the company, there's no better place in corporate treasury.
And if you look at the role of AI, you were in banking, you were in treasury. Which one do you think is going to be disrupted most by AI? Banking or treasury?
My today's view is that banking will be more disrupted by AI than corporate treasury. There are now so many elements where AI companies replace actually the entry-level jobs, and it accelerates. I would say it becomes more difficult to land a job in banking. I've spoken recently as kind of, let's say, career advice situation to some trainees or who want to become a trainee, and it's not so easy to enter into the banking world. Treasury, well, mostly unless you have a very big company being listed in one of these large indices, is, I would say, leaner, maybe not so much structured like a truly banking career, but you very quickly come into more responsible positions. You actually can drive certain projects, you can create value, and because you have such a wide space of things you should conquer, you should master, it's not so easy for AI to replace a treasurer. Of course, there are certain elements where AI will be helpful. So AI can help on booking the payables or understanding which receivable position should be matched against the inflow on that bank account. There I will help you, and that are these, I call it simpler tasks, but AI will not be in a position to judge if this cash forecast is good or bad, given the current political situation or the current business understanding, because AI here is a stochastical model. You need experience, and the experienced treasurers gain quite fast. And then they can say, look, it's helpful to have AI as my co-pilot to do some stuff and actually manage the cash position and make sure that we have things on the right bank account when it's needed, or actually we understand when most likely the customer will pay based on previous experience. But actually certain decisions today I would not trust that AI makes the right decision. And in the banking world, there are many different areas where actually AI makes a lot of value and today replaces people. Also the same for insurance.
Yeah, makes sense. So you're not worried for AI disrupting treasurers, and that's as far as I see it.
I'm not worried. I'm actually hoping that we can get more support, because Treasury, as I've seen it over the last 13 years, is always understaffed. So here I see more support than threat.
And what would be the top three things in your mind where you would use AI for? You mentioned reconciliation. Okay. What else?
You can have certain elements of the cash forecast if you have a recurring business which is driven by, let's say, clearly identifiable factors being forecasted. So maybe an interesting example there from the selector background. The turnover at vending machines is pretty much driven by the degree outside. So there's a kind of optimal range where people buy most.
By the temperature, you
drink
mean?
by temperature, yeah, because
By
they
the weather.
forget by the weather. And so their AI can give you a good forecast. Maybe you have also other, let's say, elements when you are in the automotive industry where I can give you a certain prediction and say, okay, that's mostly likely to happen in 3-4 months. That can be good. We touched on, let's say, the accounting elements. I mentioned earlier that if you have to do certain summaries, AI can help you scan the documents. Unfortunately, LMA documents, LMA London Market Association loan documents are quite long and complicated. So why not asking AI to give you the good summary of that or this element and then giving you the reference? So that is, let's say, truly shortening the time until you have the answer. But then to decide what to do with this answer or how to negotiate something, I don't see AI being the right in corporate treasury for the moment.
Oliver, thank you very much. I think we have covered a lot. I would like to actually start with a new tradition on this podcast, and that is the one thing tradition, the one thing closing ritual. So I would like to give you 1 minute, and in this 1 minute, I would like you to give you the best advice you can to a treasurer who wants to create the most impact. What is your 1 minute advice?
My 1 minute advice to anybody in treasury a few years or just in, try really to make an impact. Go to the shop floor of your company or go to the salespeople, the operations people, and understand what are their challenges. Don't spend just time with finance people or with the managing directors. You must speak to what operations needs to do, what are their challenges. And if you understand the challenges, you can come up with better ideas how to actually improve the performance of the company, cash-wise and maybe P&L-wise. By just spending time in the finance group community will always fall short to what you actually could deliver.
Thank you, Oliver. For treasurers who want to stay in touch with you, what is the best way? LinkedIn?
I would say LinkedIn, answering to all the messages, maybe a few days delay sometimes, but you will get an answer.
From you, not your AI agent.
I don't use AI agent. I hate these AI messages being sent to me. Do you want this or that? No, joke aside, you always get an answer from me, and it's personally written by me, including typos, which occasionally might be there.
Oliver, thank you very much for being with us. I found it very interesting. I really appreciate, admire, and completely agree with your approach and statements. So thank you for that.
Thank you, Philip, for the opportunity. And yeah, anybody listening to it, please reach out if you have any questions about what I took, which decision, at which moment and why, or why I believe asset-based finance is really a good tool for anybody in corporate treasury to be included for the next financing round.
Thank you. Till next time.
Thank you.